Describe double-entry bookkeeping. Double-entry bookkeeping is the accounting system in which every business transaction affects at least two accounts and is recorded using both a debit and a credit. This system ensures that the accounting equation remains balanced at all times. When a transaction occurs, one account is increased and another is decreased, or two accounts are increased or decreased in a way that keeps total debits equal to total credits. Because each entry has a corresponding opposite entry, errors are easier to detect and financial records remain accurate. Double-entry bookkeeping is the foundation of modern accounting and is required for preparing reliable financial statements. And the double-entry system, accounts are classified into assets, liabilities, equity, revenues, and expenses. Asset and expense accounts normally have debit balances, while liability, equity, and revenue accounts normally have credit balances. Debits are recorded on the left side of an account and credits on the right side. When an asset increases, it is recorded as a debit, and when a liability or equity increases, it is recorded as a credit. This consistent structure allows accountants to record transactions in a logical and standardized way that maintains the balance required by the accounting equation. Double-entry bookkeeping provides a built-in control system because total debits must always equal total credits. If the totals are not equal, an error has occurred in recording or posting transactions. This feature helps ensure accuracy and reliability in financial records. Because financial statements are prepared from these records, maintaining equality between debits and credits is essential for producing correct reports. The system also allows detailed tracking of individual accounts, which helps managers and external users understand how transactions affect the financial position and performance of the business. The use of double-entry bookkeeping also supports the preparation of the ledger and financial statements. Each transaction is first recorded in a journal and then posted to ledger accounts, where balances are accumulated. These balances are later used to prepare the trial balance and financial statements. Because every entry has two sides, the ledger remains balanced and provides a reliable source of information. This systematic approach allows businesses to maintain organized records, demonstrate accountability, and comply with accounting standards required for financial reporting. Analyze a business transaction into debit and credit components and record in a journal. A business transaction is a financial event that affects the accounting equation and must be recorded in the accounting system. To record a transaction, the accountant first determines which accounts are affected and whether each account increases or decreases. Because the double-entry system is used, at least two accounts must be involved. The accountant then decides which account should be debited and which should be credited based on the normal balance rules for assets, liabilities, equity, revenues, and expenses. This analysis ensures that the transaction is recorded correctly and that the accounting equation remains in balance. After analyzing the transaction, it is recorded in the journal, which is the book of original entry. Journal entries are written in chronological order and include the date, the accounts affected, and the debit and credit amounts. For example, if goods are sold for cash, the cash account is debited because it increases, and revenue is credited because it increases equity. Each journal entry must have equal debit and credit totals. Recording transactions in the journal provides a permanent record of financial events and helps ensure that all transactions are properly documented. Once the journal entry is prepared, the amounts are posted to the ledger accounts. Posting means transferring the debit and credit amounts from the journal to the individual accounts so that each account shows its current balance. The ledger organizes information by account rather than by date, which makes it easier to prepare financial statements. Proper posting is essential because errors at this stage can cause the trial balance to be incorrect. The combination of journalizing and posting allows transactions to be recorded accurately and summarized for reporting. Careful analysis of transactions is important because incorrect classification can lead to inaccurate financial statements. For example, recording a liability as revenue would overstate income and mislead users. Accountants must understand the nature of each transaction and apply the debit-credit rules consistently. By following the correct process, identify accounts, determine debit and credit, record in the journal, and post to the ledger. The accounting system produces reliable information that can be used for decision-making, control, and financial reporting.